They told you the system was stable. They told you the dollar was untouchable. They told you energy markets were priced correctly. All of that was a lie. This is not a theory. This is published data. This is the math they refuse to run. A quiet shift has already happened. Not in headlines, not in speeches, in contracts, in clearing rules and settlement mechanics. Oil is still flowing, but the terms have changed. The market is staring at price. It should be staring at physics. Paper claims say abundance. Physical flows say constraint. And right now, the institutions are blind. Because the petrodollar was never about oil. It was about enforcement. For decades, energy moved only one way through the financial bloodstream. Dollars in. Security guarantees out. That loop created artificial demand for paper currency. Not because it was strong, but because it was mandatory. You didn't need belief. You needed compliance. That era is ending. Not with an announcement, with an omission. Saudi oil contracts are no longer married to a single settlement path. Alternate clearing is not experimental anymore. It is operational. This isn't ideology. This is plumbing. When settlement changes, demand changes. When demand changes, pricing lies. The charts still look calm. That's the trap. Because currency strength is not set by television debates. It is set by trade flows. And trade flows obey arithmetic. Every barrel priced outside the old loop reduces forced dollar demand. Not sentiment, not opinion, arithmetic. You cannot cheat the periodic table, and you cannot cheat balance sheets forever. The United States consumes more than it produces. That is not political. That is measured. For decades, the gap was financed by reserve status. Foreign producers recycled trade surpluses back into dollar assets. That recycling is slowing. Not stopping, yet. Slowing is enough, because the system is levered. Small changes in flow create violent changes in stability. This is the part analysts always miss. They model prices, they ignore structure. China saw this years ago. Not emotionally. Logistically. Factories need energy. Energy needs security. Security cannot rely on someone else's currency forever. So settlement diversified. Quietly. Bilateral deals. Local currencies. Commodity swaps. Not to crash anything. To survive. And survival strategies always look inefficient until they become mandatory. Look at inventories. Not headlines. Look at refinery inputs. Look at shipping insurance. Look at metal stockpiles moving east. The lab always leads the chart. Battery chemistry does not care about press conferences. Industrial metals do not respond to speeches. Energy is geology, and geology moves slowly. Until it doesn't. The dollar is still strong on screens. Because the market is backward-looking. It prices what already happened, not what is locked in. The exit is not a cliff. It is a slope. And slopes kill leverage. When marginal demand disappears, prices lie. That is why price drops are mispricing. That is why volatility is opportunity. The system is telling you one story. The supply chain is telling another. And the supply chain always wins. They will say this is temporary. They always do. They said that before. We've seen this movie before. The analysts were a decade late then too, because they look at derivatives, not molecules. Oil is not a ticker. It is a physical substance extracted under pressure. So is copper. So is lithium. So is uranium. And every energy transition multiplies material demand before it reduces fuel demand. That is physics. You can electrify transport. You cannot electrify mining overnight. Timelines matter. Permits take years. Infrastructure takes decades. But currency confidence can break in months. That asymmetry is the entire trade. Institutions are reactive. They respond after the move. They wait for confirmation. By then the edge is gone. You are early because you are looking at structure. Not noise. Ignore price chatter. Watch settlement. Watch who is paid. In what unit. This is where belief systems collapse. Because money is trust, and trust is fragile. The petrodollar was trust enforced by necessity. Necessity is being engineered away. Slowly. Deliberately. No one wants chaos. They want leverage. Multiple settlement paths mean multiple power centers. That weakens any single issuer. This is not collapse tomorrow. This is erosion. And erosion is invisible until the foundation gives way. Paper assets float on confidence. Physical assets sit on the table. When confidence wavers, gravity returns. Gold does not need permission. Oil does not need belief. They exist. The dollar exists because others accept it. Acceptance is optional. The market has not priced this in, because pricing it requires admitting the old model is done. And institutions cannot admit that. Their balance sheets depend on denial. So they delay. They soothe. They narrate. Reality does not care. The chemistry is locked. The contracts are signed. Events are already in motion. You do not need to act loudly. You need to think clearly. Patience is a weapon. Let others chase headlines. Let them trade noise. Structural scarcity does not announce itself. It tightens. Inelastic demand does not negotiate. It consumes. And when currency supply expands against fixed physical inputs, value moves. Not because of fear, because of math. The last phase always feels calm, until it isn't. This is not about panic. It is about positioning. The real risk is doing nothing, sitting in paper promises while settlement shifts underneath you. The calm you feel is artificial. The pressure is real. And pressure always resolves. Not emotionally, physically. The system is changing. Quietly, irreversibly. You are not late. You are early. Stay there. The pressure keeps building, without noise. That's how systemic shifts actually happen. Not with panic, with inertia. The market still believes this is about diplomacy, about meetings, about headlines. It isn't. This is about settlement friction. When oil is sold outside a single reserve loop, the demand curve bends, not collapses, bends, and bends compound over time. Currency systems do not fail loudly. They thin out. Liquidity looks fine, until it isn't, because liquidity is contextual. It depends on who shows up and why. Forced buyers are gone, replaced by optional buyers. Optional buyers demand discounts. That discount is inflation. By another name, they will blame supply shocks. They always do. But supply shocks are excuses. The real driver is settlement redundancy. Redundancy removes leverage. Leverage was the entire advantage. Without it, issuers must compete. Competing means higher yields, weaker currency. This is not ideological, it's mechanical. They are expanding supply to offset fading demand. That equation never ends well. The charts will mislead you. They always do at turning points, because price is the output, not the cause. The cause is flow. Follow the flow. Energy is rerouting. Slowly, capital follows energy, inevitably. This is why metals inventories matter more than CPI prints. This is why shipping lanes matter more than speeches. This is why refinery margins tell you more than bond auctions. The system is adjusting beneath the surface. An adjustment always feels calm. Until the margin disappears, margins are shrinking. You can see it in hedging costs, in insurance premiums, in collateral terms. These are whispers, not headlines, but whispers move markets before screams do. Institutions cannot reposition fast enough. They are too large, too constrained. They will act after confirmation. Confirmation arrives only after repricing. That is the trap. Being early feels wrong until it feels obvious. And when it feels obvious, it is too late. This is why patience is not passive. It is active positioning. Ignore daily volatility. Volatility is the mask. The real signal is duration. How long does it take to build a mine, a refinery, a pipeline? Years? How long does it take to lose currency trust? Months. That asymmetry is fatal to paper systems. You cannot print energy. You cannot print copper grades. You cannot print geological concentration. You can only reprice it, and repricing always happens upward. In currency terms, they will say demand destruction is coming. Demand does not get destroyed. It gets rationed. Rationing means price moves, not smoothly, violently. This is why the calm is deceptive. The system looks stable because inertia is high. But high inertia means high damage when direction changes. The petrodollar exit is not an event. It is a condition where no single currency can dictate energy flow. That condition is already active. Everything from here is adjustment. Adjustment is inflationary for incumbents, not dramatic, persistent. This is the phase where disbelief dominates, where experts argue semantics, where the public is distracted, and where positioning matters most. You do not need to convince anyone. You only need to align with reality. Reality is already moving, slowly, quietly, and it does not reverse, because physics does not reverse, geology does not reverse, and trust, once diversified, never recentralizes. That era is over. The pressure is not released. It is still compressing. And compression only ends one way, with resolution, not chaos, inevitability. The inevitability does not announce itself. It accumulates. That is the mistake most people make. They expect collapse to look dramatic. They expect noise. But real systemic change feels boring, until it suddenly isn't. The dollar system was never designed for choice. It was designed for compulsion. Energy had one clearing route, one recycle loop. Break that loop, and the system does not explode. It thins. Thin systems are fragile. They hold until stress arrives. Stress always arrives, because growth requires energy. And energy is finite in form, even when infinite in demand. This is where psychology fails. People think prices falling means weakness. They think discounts signal risk. In reality, discounts signal misalignment between paper valuation and physical necessity. Oil does not care about recession narratives. Copper does not pause because analysts downgrade. Uranium does not respond to sentiment. They respond to extraction limits, and extraction limits are tightening, not because of scarcity alone, but because of timelines. You cannot accelerate permitting with money. You cannot accelerate geology with policy. You cannot accelerate chemistry with speeches. This is why transitions are inflationary. Every transition demands more material upfront. Before efficiency ever shows up, that is not opinion, that is published data. This is the math they refuse to run, because running it breaks the illusion of control. The illusion says central banks manage cycles. Reality says they react to consequences, always late. They respond to inflation after it embeds. They respond to shortages after inventories drain. They respond to currency stress after spreads widen. By the time response arrives, the physics has already won. This is why watching official statements is useless. They are lagging indicators. The real signals are subtle. Longer delivery times, higher minimum contract sizes, more prepayment requirements. These are not accidents. They are defenses. Producers protect themselves first, consumers notice last. When Saudi settlement diversified, it wasn't ideological, it was risk management. Concentration risk is deadly in finance. Everyone knows that. So why would energy exporters concentrate currency risk? They wouldn't. They are not obligated anymore. Obligation was the core of the petrodollar. Without obligation, pricing power shifts. Not immediately, structurally. This is why China plays the long game. They do not need dominance. They need optionality. Optionality is power. The moment you can choose, you are no longer captive. Captive demand props up weak systems. Free demand exposes them. This exposure is slow, but relentless. Every trade settled outside the old loop compounds the effect. It is cumulative. Small flows matter when repeated millions of times. That is how erosion works. Not with force, with repetition. They will continue telling you the dollar is strong, and on a relative basis it is. That is the trick. Relative strength hides absolute decay. Everything can weaken together. But the weakest structure fails first. Paper backed by trust is weaker than matter backed by physics. Always. This is why physical premiums rise quietly, while paper prices stagnate. That divergence is the tell. It says one thing is scarce, the other abundant. Paper claims multiply easily. Physical extraction does not. This gap widens before repricing. By the time prices move, the opportunity window is closing. This is why institutions miss it. They need liquidity. Liquidity requires paper. Paper requires belief. Belief requires stability. Stability is already compromised, not visibly, structurally. This is the phase where denial dominates, where experts argue semantics, where everyone wants confirmation. Confirmation comes after the move. It always has. The public will be told this was unpredictable. It never is. The signals are everywhere. They are just boring. And boring signals get ignored. Energy corridors being rerouted, metal stockpiles migrating, insurance clauses tightening, collateral terms hardening. These are the fingerprints of stress. Stress does not vanish. It transfers from one layer to another, from currency to commodity, from paper to physical. This is why inflation feels persistent, not spiky. Because it is structural, not cyclical. Cyclical inflation can be fought. Structural inflation must be endured. Endurance favors holders of real assets, not traders of narratives. This is not about getting rich fast. It is about not being diluted slowly. Dilution is invisible in calm markets, but devastating over time. The biggest mistake is assuming tomorrow will resemble yesterday. Systems change gradually. Until they don't, then everyone pretends it was obvious. This is that moment, not the end. The inflection, where decisions made quietly determine outcomes later. You do not need urgency. You need conviction. Conviction grounded in reality. Reality says energy demand is inelastic. Reality says supply growth is slow. Reality says currency issuance is accelerating. That combination resolves only one way. Not explosively, persistently. This is why patience is critical. Noise will try to shake you. Volatility will try to confuse you. Headlines will try to distract you. Ignore them. The signal is duration. How long can this imbalance persist? Longer than most expect. Long enough to break assumptions. Assumptions are fragile. Physics is not. The system is already adapting. Producers are adjusting terms. Consumers are adjusting sourcing. Banks are adjusting exposure. These adjustments do not reverse. They lock in. Once locked in, the old system cannot be restored. Trust, once diversified, does not recentralize. This is the quiet truth no one wants to say, because it implies permanence, and permanence terrifies leveraged systems. The dollar does not vanish, it weakens in relative power. That is enough. Enough to reprice commodities, enough to shift capital, enough to reward patience, enough to punish complacency. You are not waiting for collapse. You are watching a transfer from paper confidence to physical constraint. Transfers do not make headlines early. They show up in hindsight, when it is too late to adjust. The events are already in motion, not accelerating, yet, but momentum is building. Momentum does not require belief. Only time, and time is already passing, quietly, relentlessly, inevitably.